Bismillahirrahmanirrahim. Dear students, today we'll start our next topic that is related to risk. And as we have discussed foreign currency risk in the previous topic, now today we will be discussing the interest rate risk. As risk is actually a situation of uncertainty, so the risk faced due to changes or adverse movement of interest rate is called as interest rate risk. As when we talk about financial managers, they face different types of rates which arise in the changes in the interest rate, and there is a lack of uncertainty about the amount and timing of cash payments and cash receipts, as we have seen in the foreign currency risk as well, that when there is an adverse movement, or when there is no certainty about the future movement of the currencies of different countries, so there the risk arises from that. So is the case with interest rate risk, in which the managers are not sure that what would be the future changes, or what would be the movement of interest rate in the future. As companies are there, they borrow money because for their financial needs, they're fulfilling their different working capital and different type of other needs, because at any time the business needs money for fulfilling their activities. So in that case, many companies borrow, and they'll choose to borrow from in form of bonds. They issue bonds, and mostly when we talk about bonds, so the rate of interest on bonds is somehow fixed. And in the case of bank loans, because there are lots of options when you are dealing in a corporation, as a corporation, so in that case we can go to banks, and the bank's rates are rather a floating one as compared to the rate of interest which is being given on bonds. So what type of risk is involved in different type of bonds, and what type of interest, what type of risk involved when you are indulged in like getting loan from banks. So this is actually deciding about this in order to mitigate the maximum amount of risk, is actually what is the major topic we'll be discussing in this, that how you can minimize the risk by choosing by seeing that how you can minimize the interest risk exposure, and how you can develop a portfolio of debt which will give you minimum amount of risk. Now there are different reasons which will have an impact on interest rate, like for example default risk. Default risk is a situation in which the companies have a bad credit rating, or we can categorize companies which have lowest default rates and companies which have a highest default risk. So the companies which have lower default risk would be offering would get loan on a lower interest rate as compared to the companies who have higher default risk. Because if you have seen in financial management class, or in your business finance class, we have discussed that the treasury bills are the bills treasury bills which is being issued by government, and they are short-term securities. So these are the bonds which have no default risk, because government can pay you by any time by by issuing notes, or at any time by borrowing from any other source, but they don't default on their payment. So they have no default risk. So the interest on treasury bill would be the lowest one, and which is actually called as risk-free rate. But as the default risk increases, which it will increase the amount of interest to be offered to the investors, because you have to give them a premium for your default risk. So default risk is associated with the companies for not fulfilling their terms and conditions related to the bond or the loan terms and conditions, like the companies have failed to pay interest rate on time, or the companies have failed to pay the total amount of money which is being borrowed on time. So those companies which have these higher default risk, they have to offer higher interest rate in order to get compensation for the default risk default risk. Then another thing is your liquidity risk, which is actually associated with the timings of your bonds. The bonds or the loans which are being borrowed for a shorter time period, in that case, the companies have to give, or they have to offer lower interest rate as compared to when the amount is borrowed for a longer time period. So that is called as liquidity risk. Then income tax consideration is also very important. There are some kind of bonds in which are free from income taxes, federal taxes. This is mostly in the case of US, in which there are certain municipal bonds which are being issued at local level, and they are not eligible, or they are not supposed to pay federal taxes. In that case, they are free from any type of federal taxes, but there are other bonds which have to pay taxes. So on those bonds which you have to pay taxes, so obviously they'll be giving you lower interest rate as compared to the bond which you don't have to pay taxes. Then another thing is the yield curve. Yield curve is associated with the timings of a bond, that different bonds have different interest rate regarding their maturities. Now, a yield curve, it is actually a curve which is plotted on the graph, and it plot interest rate of bonds having equal credit quality, but they have different maturity date. And actually, the term structure of interest rates refers to the way in which the yield of debt securities or bond varies according to the term of that securities, like to the length of time before the borrowing will be repaid. Or we can also say that yield curve is an analysis of the relationship between yields on the debt with different time periods of periods to maturity. Or a yield curve can also have any shape, and can fluctuate up and down for different maturities. And when we talk about a different shape of or different types of yield curves, so there are normal, inverted, and flat. Then upward sloping, also known as a normal yield curve, is where longer term bonds have higher yield than shorter term ones, while normal yield curves point to the economic expansion. Downward sloping curve point to economic recession. So in the next 2-3 slides, you will be seeing the different types of yield curves. First of all, we will be there is a normal yield curve. This is a normal yield curve. A normal yield curve is actually a curve in which we can see that longer maturity bonds have a higher yield compared to with shorter term yields due to the risk associated with time. Like we can see that when you borrow for a shorter time period, in that case there is a lower liquidity risk. You can your amount is quickly converted into cash, and you can use that amount in any other source. But when there is a longer term bond, it is actually bind, or it is actually fixed for a longer time period. So you have to pay compensation for that, and that is called as liquidity risk premium, in which you have to pay higher interest rate to the bonds which have longer maturity, because you are taking that money for a longer time period. Then if you look into the inverted yield curve, this shows that the shorter term yields are higher than the longer term yields, which can be a sign of upcoming recession. Like this is a yield curve which shows a different situation, and it shows that your short term maturities are giving you, or the shorter bonds will are is giving is actually offering higher interest rate as compared to longer term bonds. And it indicates that in the future you will be having recession, and the future would be a little bad for the economy. Then third one is your fat yield curve, or you can also call it as a humped yield curve. It is actually shows that the shorter and longer yield curves are very close to each other, and it also actually is predictor of an economic transition, that there would be an economic transition in the future. If we look into the curve, you will be getting same return on 1 month bond and 30-year bond. So that is called as the flat yield curve. Now there are different theories which can explain the reason why there are different type of yield curves. First of all, there is pure expectation theory or expectation theory, which is associated with expectations of the investor. As this theory has certain assumption, like they are their assumption, the major assumption is that the bonds of different maturities have are pure substitute. Like if you want to invest in 5-year bonds, or if you want to invest in 1-year bond for 5 years, so the both are the same. You'll get the same type of return in both type of investment. So based upon that assumption, first of all, we say that the shape of yield curve varies according to investors' expectation of future interest rate, because it, as the name suggests, that it is expectation theory. So this is actually associated with expectations of the investor. When the curve rises steeply from left to right, it indicates that the rate of interest are expected to rise in the future. And then there is more demand for short-term securities than long-term securities, since investor expectation is that they will be able to secure higher interest rate in the future. When you are expecting that the future rate would be higher in the future, so obviously the short term the demand for short term rate increases as compared to the long term bonds, and the price of short term asset will be bid up, and the price of the long term asset will fall. So the yield on the short term term and long term asset will fall and rise. Then the if we look at the falling yield curve, in which we can see that the yield curve is falling when there are the return on short term bond is higher than the long term bonds. So what is the reason behind that? That as when we say that the falling interest rate implies that interest rates are expected to fall. Same, it is actually associated with the expectation of the people. Like people are thinking that in future the interest rate would be lower, so that's why they want to invest more in the short term bonds, and demand for short term increases, or and you have to pay higher interest rate on short term bonds. Then there is another type of bond that is, and actually in this falling yield curve also shows the indication that in the future there would be a recession, which is actually the lowest economic activity in that economy. Then a flat yield curve indicates that the interest rate are not expected to rise in the future. Obviously, there is people don't have any expectation that interest rate would be higher in the future. So there would be the interest rate on short-term bonds and long-term bonds are same as the flat yield curve is showing. Now, the other theory is market segmentation theory, and there are certain key assumptions associated with this theory. As it is, the name suggests that there are different segments in the market. So according to them, the bonds of different maturities are not substitute at all, as compared to pure expectation theory, in which they say that bonds of different maturities are pure substitutes. In this case, they are saying that bonds of different maturities are not substitute at all, and the market is segmented, and interest rate at each maturity are determined separately. Like they are saying that market is divided into different segments, and as according to the maturities of the market, the different interest rate are determined by the fundamentals of each segment. Like if you have a short term bonds, so there are certain factors in the short term bond market, and based upon that their interest rate is determined, and so is the case with intermediate and long term bonds. So according to them, the people typically prefer short-term holding period, and thus have higher demand for short-term bond, which have higher prices and lower interest rate than long-term bond. And when we talk about market segmentation theory, according to the market segmentation theory, the two ends of the curve may have different shape, as they are influenced independently by different factors. Mostly investors are risk averse. They want to minimize their risk. So they want to invest in segments of market that match their liability commitment. Like if you need funds for your working capital, so obviously you'll go for short term, in the short term market or a money market. But if you want to invest in for a longer time period, like if you want to buy a machinery, or if you want to have expansion of your plant, so in that case you need money for a longer time period. So in that, so you have to go for a for long term for long term loans, for long term bonds. So bank tends to be active in short term end of the market, and pension fund would tend to invest in long term maturities to manage the long term nature of their liabilities, because pension funds are there and they need this fund for after their retirement. So obviously in that case they'll invest in longer term maturities. Therefore, the supply and demand forces in various segments of the market is influenced on the shape of the yield curve. So, actually, market segmentation theory explains the wiggle seen in the middle of the curve, where the short term end of the curve means the long end. It is a natural disturbance where two different curves are joining, and the influence of both the short term factor and long term factors are weakest. According to the market segmentation theory, the market is divided into different segments, and based upon their maturities. And in each segment, the interest rate is determining the demand and supply forces of that segments. Now, the next theory is liquidity preference theory. As the name suggests, that liquidity means that you want to hold money in a form of cash rather than any type of investment. So that is called as liquidity preference theory. The major assumptions of this theory is that bonds of different maturities are substitute, but are not perfect substitute, and investor preferred a short term rather than long term bond, and they want to the investor must be paid positive liquidity premium to hold long term bonds. Like if you want to attract investors, in that case for a longer term period, or for a longer term bond, you have to provide them extra return or extra interest, that is called as liquidity risk premium. Therefore it will attract them, and they will invest money in your bonds, or in any type of debt instrument you are offering, because there is a natural preference of investor that they want to hold cash rather than any type of investment. Even there is low risk, like on government securities, like if you have seen that treasury bill have risk free rate, but in that case also they want to put their money in cash rather than any form of investments. So they have to be compensated with higher yield for being deprived of their cash, for be indulged or being tied up in certain kind of investment. So you have to pay certain liquidity risk premium. The normal shape of the yield curve as being upward sloping can be explained by liquidity preference theory, because people want to have more cash rather than investment, and in order to attract those investors, you have to provide a higher interest rate on a longer term bonds. Now, there are different ways and there are different instruments which are used to decrease the risk associated with interest rate movement, and there are different instruments which are actually given below, like a forward rate in agreement, interest rate agreement, interest rate futures, option, interest rate caps, floors and options, and swaps. So we will discuss one by each of them one by one in next slides. Now, another instrument is interest rate futures, as we have also discussed currency futures. Interest rate futures also work in the same way as the currency future, and which is a help to lock the company into effective interest rate, and they can hedge both adverse and favorable movement of interest rate. As this is a financial derivative that allows the exposure to changes in interest rate. interest rate futures price move inversely to interest rate, and the investor can speculate on the direction of interest rate with interest rate futures, or else use the contract to hedge against changes in the interest rate. As futures can be used to fix the rate on loan and investment, they can be seen as the operation can be seen that as with an FRA, a loan is entered into in normal way. Suitable future contracts are then entered into a separate transaction. A future contract is promised. For example, if you sell a future contract, you have a contract to borrow money. With that, what you are selling in the promise to make interest payment. However, the borrowing is only notional. We close out the position by reversing the original deal before the real borrowing start, that is before the expiry date of the contract. This means buying futures if you previously sold them to close out the position. The contracts cancel each other out, that is, we have contracts to borrow and deposit the same amount of money. The only cash flow that arises in the is the net interest paid or received, that is the profit or loss on the future contract. As with the futures, each contract is a for standardized amount where with a set of maturity date. A whole number of contracts must be dealt with, and rules for whether to borrow or sell interest rate future contract is that for borrowing, sell futures now and buy them back on closeout, and for depositor, buy future now and sell them on a closeout. And the price of the future moves inversely to interest rate. Therefore, interest rate rise when loan are more expensive, loss from extra interest. Futures price falls, profit made from having sold at one price to open the position and then buys at lower one to close it. And net position is that interest cost effectively fixed. And when interest rate falls, loans are cheaper and gain cash on interest saving. And futures prices rises, losses made from having sold at one price to open the position and buying at higher one to close. Interest cost would be fixed. Options is actually another type of financial derivative, or you can say that it's a form of hedging interest rate risk. So these are financial derivative that will give the buyer the right but not obligation to buy or sell underlying asset and agreed upon price and date. Like you will decide today that you will buy that amount, that thing or that asset in some future date with fixed amount of price, and but you are not there is no obligation on it. If you want to buy, you can go, but there is no binding upon that. And call option and put option form the basis for a wide range of option strategies designed for hedging income or speculation. There are actually two type of options: call option and put option. Call option is actually when you want to buy something, and put option when you make a binding for selling something in future date at a predetermined price. So these type of options can be used in varieties of ways in order to hedge against certain income, interest, or certain speculation. Although there are many opportunities to profit with option, investors should carefully weigh the risk, because when you are using this option, there are certain things which can be changed in the future, or many other things which lead to the adverse movement in interest rate or any other thing. So these options would be carefully used while exercising, or when you are hedging, which are using them for minimization of risk. Now another thing is your interest rate caps. When caps means that you are actually putting a limit, that how the interest rate should rise and at how much the interest would be allowed to increase. Mostly they are used in mortgages, and mostly variable mortgage, and also in adjustable mortgages loan. And in this case, interest rate caps can have an overall limit on the interest for the loan, and also be structured to limit incremental increase in the rate of loan. This is a type of instrument which can give borrower protection against the dramatic rate increase and also provide a ceiling for maximum interest rate. And we can say that it's a type of options which set a maximum rate if the actual interest rate is lower, maximum interest rate, and if in the case when there is interest is lower, so in that case we will not use this option and we will let the option be lapsed. Interest rate collars and interest rate floor are actually associated with interest rate caps. Just when we talk about interest rate caps, so in that case the option is used for a maximum rate that you cannot go, you have to fix the maximum rate. But in the case of interest rate floor, it is an option which is used to set the minimum rate. And if the actual rate which is actually being given on a security is higher than that option, the option is allowed to lapse, because if you they are actually they have limit their rate up to a minimum level. The rate should not go down to that minimum level. And this is exercised when the minimum rate is actually the return is less than the minimum rate. But if the rate is higher than minimum rate, so this is actually not used. But in case of interest rate collar, it is actually combination of cap and floor. Like this option of this option actually set both maximum and minimum range for the interest rate paid or earned. So if the buyer will buy a cap to fix its maximum rate paid, and sell a floor, and if interest rate fall, then it would get no benefit from the cap but would make premium by selling the floor. And the same is case with the depositor, he will do the opposite. The last hedging instrument used in interest rate risk is swaps. As the name suggests, that swap may mean, and swap means exchanging something. So in this case, we are changing the contract, or changing the or swapping the terms and condition of the loan or any other thing. So when we describe the swap, actually it's a financial derivative, and it is a contract in which one party exchanger or swaps the cash flow or value of one asset for another. That you will be swapping one asset with another because you want to get the cash flow associated with that asset with your asset, which has different kinds of cash flows. For example, a company paying a variable rate of interest may swap its interest payment with another company that will then pay the first company a fixed rate. Like if you have invested in a certain contract, or invested in certain asset which is giving you flexible rate, or which interest rate variate, and you want a fixed interest rate, so you can swap it with any other with the asset which is paying the fixed rate that you want. And also swap can also be used or exchanged for another thing or risk or type of loan in which your the or risk, like the potential for a credit default in a bond. Like if you have a potential there are certain bonds which have a default risk or something like that. So in order to minimize that, you can exchange it with any other asset. And also it can also use for an adverse movement of interest rate. And then like if you are expecting that the instrument you are holding, or any other kind of security you are holding, and its interest rate will decline in future, so you will also swap it. And also it's a kind of instrument which can be used by different firms that want to desire a certain instrument or certain amount of asset, or you can say they want to borrow from any other firm which will provide them loan on easy terms or a less expensive terms. So a swap can use in any of these situations.